Welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is the 6th of October, 2023. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all that the charts that we reference are posted to our Twitter account at RenMac LLC and our RenMac LinkedIn page. And if you're listening, but you're not an institutional client and keeping up with the markets is important to you, then you should visit RenMac Access. That's renmacaccess.com. It's a site that we designed to provide RIAs and intelligent investors with some of the insights to the ideas and some of the topics that we're discussing here today. Again, that's renmacaccess.com. Neil, it's payroll Friday, so you've got the floor, the white hot spotlight's on you. Clearly, the markets didn't like it. How big of a miss? I guess it wasn't a miss, a surprise, upside surprise was it to the consensus, and what was your early take?
It was a big miss for bond market bulls, I guess, right? So, yeah, I mean, there's just no signs that the economy is really decelerating in any meaningful sense. And you should be open to the possibility that labor market conditions are stabilizing. The number was 336,000 for non-farm payrolls in September. I mean, that's just a monster number. I think what's interesting, given our line of work, is that
a monster number. Just to preface it, you sort of joked when somebody asked you what the range was or what you thought the number was. You joked between 0 and 300,000. So even in your ridiculous range,
right,
it was outside the realm of that ridiculous.
On the high end of my sort of finger in the air forecast. No,
right.
I think what's interesting for our line of work, right, is just to focus on the things that the detractors are saying, right? We tend to, as people know, reside more so on the sunnier side of the mountain. So let's just focus on what the growth pessimists have been talking about for the last several months. Revisions. They've been talking about revisions. Revisions are up. The 2-month revision was 119,000. So if you put that with the 336,000, you're talking about something north of 450. Okay. They've been talking about cyclical jobs growth. Cyclical jobs growth was up. If you look at manufacturing employment, it was up. Now, this is probably going to be the last clean read for manufacturing for a little bit because of the UAW strike. So unless that's resolved soon, which doesn't seem to be the case, you're probably going to start to see some auto workers fall off, in the next report because they're striking at some plants. But there's plenty of momentum in the economy, and I think that's what's important to keep in mind. We can focus on some of the ins and outs, right? Like, so the establishment survey, which is what drives the headline payroll number, that was a lot stronger than the household survey, which drives the unemployment rate. But, I think for our listeners, what it's important to realize is that, right now, I do think that the bears have generally been, at least on the economy, they're grasping at straws. I mean, when they're talking about revisions as sort of the linchpin for their views, I mean, that's ridiculous. It's just, I mean, revisions never change the underlying story in the economy, right? Like, the likelihood of a positive jobs number when it comes out being revised to a negative one, I mean, that's rare, so rare that it's not even worth thinking about. So to me, it's like, it's very important in our line of work, I think, just to spot BS, right away. And when people are talking about revisions, I mean, in my mind, that's like a great example because the revisions never are enough to justify. I mean, you just go on and on. The other one, Jeff, was, gross domestic income, something that a lot of these people never even heard of up until like 6 months ago. Now it's all of a sudden their favorite indicator. I could name names, but why do that? But, gross domestic income, that's really weak. That's a better measure for GDP than GDP. Well, so the story going, well, GDP is overstating the growth in the economy. Well, guess what happened? GDI got revised up to GDP. I mean, people that understand the data knew that, the government would probably find more income, which they did. And it had to also do something with remittances around the Fed. But at any rate, I mean, it's just one of these things where it's important to keep in mind, like, be able to spot nonsense for what it is. And for me, like, if you just focus on claims, you focus on employment, those tend to be the more stable measures of activity, and they're telling you that the economy is fine, too fine, maybe. And I think that's why the bond market might be reacting the way it's been.
Where were the gains?
I mean, they were broad-based. You had manufacturing up, you had construction up, so the goods producing industries did reasonably well. Truck transportation started to recover because you did have the yellow bankruptcy was a big headwind for the employment report last month, and that kind of came out.
Yep.
But government employment is the other one. I mean, that's been something that's been steadily rising across all levels. But the fact that state and local governments in particular, generally speaking, have been flush with cash, they're going out and hiring more people, and that makes sense.
Well, this data is going to be really important because we are getting to that threshold level on real yields. It's roughly 2%, where it does start to impact the equity markets. We're also seeing that impact on yield sensitivity, right? So when we look at sectors and the performance of sectors and match that up historically with the most and least sensitive to yields, it's certainly starting to align itself, and it has been now for about 6 to 8 weeks, more with this yield sensitivity. In other words, the market really didn't care as yields were somewhere between 0 and 4%. But as we've pushed that higher, that sensitivity to those rates has actually started to increase. And that's, I think, interesting because it's not necessarily what you would otherwise maybe presume it should be in terms of the strength and weakness. And just as a point, real estate utes are historically weak, and they are. So that's not, I don't think, a big shock. Energy tends to do well, and it is. Financials tend to do well, particularly banks, but they're not. And we are definitively not people that try to pound square pegs into round holes. It's just not our MO. But I think the other thing that's interesting here, so that's an outlier where banks certainly look to be one of the more weaker industry groups in the market, and has frankly been a place that we've been short since the summer. The other that's strong historically and has been strong are industrials. So industrials don't have that same sort of bite that you tend to see historically to these yields. People are always going to want to know where tech is. Tech's right in the middle. It's got a little bit of a negative association, but certainly not enough to make a call. So I think that these yields will be important as we go forward, particularly for what the market's now telling us in terms of the sectors. But we'll get back into that a little bit. I want to hit on what's happening in DC, Steve, because obviously it's a mess down there. McCarthy now got the boot since our last podcast. What's the path? Is there anything to salvage this without really stinking to high heaven, or is this just going to be an ugly period of our history that we're going to have to look back on and hope we learn from?
Yeah, Neil talked about all the people that were gaining jobs. McCarthy was clearly not one of them. Moving forward, it's a lot of uncertainty, which markets generally do not like. The timeline right now, it looks like there are two front runners in the race to replace McCarthy. You have the number 2 House Republican, Steve Scalise. Shouldn't let the number 2 part fool you. There's no love lost between them. And you also have House Judiciary Committee Chair Jim Jordan, outspoken critic of Joe Biden with respect to the impeachment inquiry. You have McCarthy whipping for Jordan, and you also have Donald Trump whipping for Jordan in terms of their endorsements. Whether or not that's going to work, you have Jordan sort of running more of an outsider campaign. You have Scalise running more the insider campaign. I think we'll probably find out on Tuesday whether or not Republicans are able to coalesce behind one of them. That is when they're going to have an internal meeting. And ordinarily, the way it works is you have that internal meeting, and then after the vote, people who are voting for somebody else sort of more or less get in line, so you can bring that person to the floor and have enough votes to proceed. That didn't happen with Kevin McCarthy, and so there's reason for skepticism whether or not that will happen now. I'm sorry, Neil.
No, I was just going to say, I mean, have you ever seen a scenario where one of the major news outlets is running a debate in advance?
I'm not aware of that ever happening. Right? And I believe that's going to be closed to us. And I think
no, they announced that it's going to be open to the public but closed to the press. So they'll air it.
Okay, well then
You
that's
don't know
news to
whether it's
me.
live or taped.
Yeah. No, I mean that I think goes probably more to the Jordan aspect of trying to run more or less an outsider campaign. I think what it shows you is that just Republicans were not prepared for the fallout earlier this week. And why this should matter moving forward is if you just look at the incentive structure for how it played out for Kevin McCarthy. I don't think he did himself a lot of favors by promising many people many things. But that said, he did work with Democrats to avoid defaulting on the debt limit. He did work with Democrats to avoid a government shutdown. So when you're talking about a potential replacement, whether it's Jordan or Scalise, they're both more conservative. I don't think they have as much incentive, seeing how McCarthy was treated, to make that compromise. So when you talk about November 17th, probably increases the odds now that we could shut down the government again. Obviously, this is going to impact Ukraine aid. Scalise has been on record prior for supporting it. Jordan has not. And then you look at just the funding fight we're going to have at the end of the year. It's going to be harder to reach a resolution there. Again, under that debt limit deal, if no resolution is reached, continuing resolution into the following year's 1% cut across the board, that really hits defense disproportionately high. Just in general, the lack of bipartisanship, it's going to make it hard to address structural challenges. Look, the debt's rising, the cost to service it is increasing. At some point, that's going to crowd out congressional spending. And I think that's one of the reasons you see more people wake up to the structural challenges here, but unlikely at this point that we're going to see any resolution on either side to address them.
Yeah, I mean, it's pretty shocking. But have there been any polls since that show who the winners and losers are? I mean, clearly the Republican Party seems to be in disarray around this. Is that being reflected in the polls, and is that going to help Biden, at least for now? I mean, I know we're still a year away, but is that likely to be more of a benefit to Democrats here?
Well, I think short term, people that were probably the most disappointed that the government didn't shut down was the White House. They were looking to get that distraction from Biden's poll numbers. There was some news about his involvement with respect to his son's business dealings. So I think the fact now that the focus is on Republican disarray and just calls into question, can you trust Republicans to govern? Yeah, they'd much rather the media focus on that rather than their own candidates' challenges. But as I mentioned, with respect to governing, careful what you ask for, because while this may provide that contrast you're looking for, I just think it's going to be much more difficult to govern moving forward. And at some point that may start to blow back on Biden. And I should just point out too, we got these questions from some clients with respect to, could you see a bipartisan consensus emerge for a candidate with moderates from both parties? The answer is no. I mean, this isn't the West Wing. It just doesn't work. The incentive structures aren't there. Just look at who Republicans are putting up. Again, they're more to the right of McCarthy. There's been some speculation about whether Donald Trump would come in and actually fill the role of speaker. Constitutionally, you don't have to be a member of Congress to be the speaker. So is it technically possible? Yes. Do I think it's practical or probable? No, I don't, because I don't think Trump is going to have the support to become speaker amongst the Republicans. And I don't believe he can be temporarily appointed to that position. That's why you see Patrick McHenry in the role now, just because he was on that designated list. So my guess is that's why he sort of threw himself behind Jim Jordan. I don't think he would have any interest in legislating personally either.
Well, Jim Jordan certainly is not the centrist candidate. I mean, that's not that's
relatively
not checking that
speaking,
box, as you say.
You could argue that may boost Scalise's chances. I mean, between the two of them, Scalise seems relatively more moderate.
Right.
So at some point, maybe that helps his candidacy to move forward. But if Republicans don't have somebody by Wednesday, I think the fear is that it could just drag on potentially for weeks. And the thing right now, without a permanent speaker, you can't move legislation in the House. So again, that's why that November 17th funding, as well as Ukraine funding, are going to be more significant issues right now.
Well, Biden's building another 20 miles of wall, so maybe that's his olive branch, reaching across the aisle by building walls.
What's interesting, his Homeland Security Department sort of put out a statement that suggested, that the wall was needed because we have a surge of migrants there at the southern border. Biden's sort of rationale didn't really line up with that, saying, well, the money had been funded through Congress and he was sort of forced to do it. I don't know that he was forced to relax 27 federal laws to proceed with the construction on that. So something to watch moving forward.
Yeah, ridiculous. Well, let's talk about markets a little bit. We got through that 65-day low, which did deteriorate our trend model. Still bullish, but more in a bullish neutral position. When we go back and look at that historically, actually, the returns are very good as you go out the next 3 to 6 months. So not, having a little bit of a dent in the armor is certainly not a catastrophic event by any means. We're now approaching the 200-day moving average, which is ascending, and that's important. So the path of least resistance has been higher for equities, even though we've pulled back. And I just want to remind people that we are now in this seasonally strong period for equities, or at least getting there. October tends to be roughly flat to the risk-free rate historically. September tends to be about 125 basis points below cash levels historically. So clearly, getting or putting September in the rearview mirror is helpful for the bulls. October is roughly flat with some consternation in the first half of the month, and then usually some type of meaningful low in the back half. And then November, December, and January all run very close to at least 100 basis points above cash returns historically for the remainder of the year and the first year of the next. So that's good news. The seasonality is kicking in. We did start to see put call data on the composite increase or swell. So there is some concern around positioning with the index or on the index level. And that's good news. You want to see people starting to hedge out their overall exposure on the composite, maybe while keeping hopefully underlying cash positions on the long side. But the real kicker for us last week, or this week, I should say, was a spike in 20-day lows. So when 20-day lows get roughly above 50%, there's a little more precise number that we keep for clients. That's good news. And we got above our threshold level. And that historically, with about an 80% probability, gives the next 3 months a winning or positive return versus a negative return. Doesn't work every time. Nothing does in this business. If you ride horses, you're going to fall off. But there's a lot of good things that are coming together within this market, in our view, for a tactical move that can drive equities higher into the fourth quarter. Neil, what are you watching next week?
Next week is going to be all about inflation, CPI inflation, producer prices, import prices. That'll be on the brain next week. The market's looking for 0.3% for core CPI inflation. This isn't the timing of this report. You're not going to capture the drop in gasoline prices, right? That's going to be a big story for October. And that's going to be a meaningful tailwind for disposable income. You will see a sizable drop in gas prices after seasonal adjustment in October.
How big is that? I mean, I without trying to quantify it specifically, like, is it a quarter of the number? Do you see? I mean, I know there's something to the magnitude.
I mean, motor fuel is not a large part of CPI. I think it's like around 5% maybe, but obviously when you have outsized movements in gasoline prices, it can contribute a lot one way or the other to the swings in CPI on a month-to-month basis. And so that's why we kind of strip out food and energy from the price. But for consumers, I mean, that's a very visible thing that they buy quite often, right? And so that's why we do focus on it. And quantifying the tailwind for incomes. I mean, if you're talking about basically, we consume 130 to 140 billion gallons of gas a year. We might say 50 to 60 cents per gallon. So you're talking about, running the numbers, that could be like up to half a point for income. And the money will probably get spent somewhere else. I think that might be why it's not bringing that much relief to the fixed income market, right? Because even though prices are down, it's really just a tailwind for incomes. And if that's happening, I mean, how much are conditions really tightening as a result?
Yeah. Well, not just in triple B spreads, right? That's one thing that we continue to watch for these triple B spreads. and they've been remarkably stable. So we'll keep an eye on those. Steve, next week down in your neck of the woods, otherwise known as the swamp, rightfully so. What's happening?
Well, again, we'll watch that speaker drama, whether Republicans have the votes or not. If they don't have, I say by Wednesday or Thursday, there's probably a good chance it could go on for quite a while with no clear resolution in sight. Outside of this, I'd watch a couple things at the presidential level with respect to third parties. RFK Jr. is supposed to announce a bid, I believe, Monday as an independent. He was somebody who was running in the Democratic primary. Clearly, we haven't seen any televised Democratic primaries. His ability to get on ballots across all 50 states is something that's going to be important to watch moving forward. Polls suggest he would pull from both Trump and Biden, but a little bit more from Biden, at least based on the current polls. The other thing to note too is that Cornel West is going to run as an independent. That's sort of been suggested before, but what's the news now is that he's not going to be with the Green Party. He's going to mount his own independent campaign. And again, that's important because the Green Party did have the infrastructure to get West on all 50 states. It remains to be seen whether or not he can do that. I know Democrats will work to prevent him, at least in the swing states, from doing that. So I think that's worth noting.
Anything on Menendez? It's just like the hits just keep coming.
Yeah, I mean, the latest I heard was that his wife had been involved with, I think, a hit and run. So I don't know how that relates to the latest indictments, but look, the reaction to Menendez has been different this time. That's because there's not a Republican governor. They want a Democrat to replace him now. If I Menendez, I might agree to step down if he gets his son, who's a representative there in New Jersey, to take the seat. We'll see if that happens. But, you know, when you reach that level, you're sort of always wheeling and dealing. But how quickly, once you change from being an asset to a liability, you are abandoned by your party. It's just one of the unfortunate things of politics, but that's how the game's played.
I mean, does Murphy have incentive to do that, to anoint the son?
I don't know that I think he would get a lot of heat if he appointed the son. What I don't know is in terms of the national pressure, because the Democrats have an unfavorable Senate map. They just have 23 seats to defend compared to only 11 for Republicans. 3 are in states that Trump won, and a lot are even in contested seats. So Democrats nationally have to be judicious with how they allocate the resources. They don't want a bunch of money going to some unnecessary primary fight in New Jersey when they could probably arguably better spent elsewhere. So depending on the national, I guess, pressure on Murphy, will he do that? My guess is he probably won't. Keep in mind, Murphy's somebody who has presidential aspirations himself, and part of that is getting a larger majority of Democrats to work within a General Assembly, and they have their own elections there this November. So I think there's some short-term interest there for him, which is probably why he's acting the way he's acting.
Yeah, well, we certainly would hope that he's a pretty rational guy and can kind of see through that, but you never know in that business. Well, 4,200 is roughly the support level that represents the pivot point and the ascending 200-day moving average on the S&P. We'll continue to watch that level, but look, we're in the camp that we think we can trade as high as 45.41 on the S&P between now and year end, and really kind of leave the bears in the dust. I do believe that these yields are important. I believe the yield impact model is working against that call, but I also believe what we're seeing from utility staples and some of these capitulative signs, that a lot of that concern is being priced in, and tactically we can probably get some relief that's going to be beneficial to stocks between here and the end of the year. How that looks in the grand scheme of things, maybe potentially a bigger top formation and a trend change. That's getting the cart before the horse, but we are seeing deterioration in the all world index and in Europe and some of these emerging markets, which is obviously some area of concern. So shorts should be looking in those places, not necessarily the S&P, for ideas on the downside. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and RenMac LinkedIn page. And if you want deeper insight, you can always join us at RenMac Access. That's renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.